Recession 2025. You've heard the buzz. But what if the biggest warning signs aren't the ones splashed across your newsfeed? What if the real danger lies hidden, buried beneath manipulated data, overlooked economic signals, and lessons history desperately wants us to remember? Welcome back to Truth Decoded. Today, we're diving deep into the unseen forces shaping our economy and the subtle signals that many miss, yet could spell disaster in 2025. Inflation, economic indicators, and eerie parallels to past crashes are converging. Are you ready to uncover the truth behind the headlines? When it comes to predicting recessions, mainstream media typically focuses on GDP drops or unemployment spikes. You'll see headlines screaming about job losses or shrinking economic output. But these are lagging indicators. They tell us what's already happened. They're like looking in the rearview mirror while driving. You can see where you've been, but not where you're going. By the time these figures are widely reported, the recession may already be underway, and the opportunity to prepare has passed. To truly get ahead of the curve, we need to look beyond the obvious and focus on the hidden signs, the subtle shifts in the economic landscape that offer early warnings. These indicators often operate beneath the surface, unnoticed by the casual observer, but they hold valuable clues about the future direction of the economy. One such indicator is yield curve inversion. The 2-year and 10-year Treasury bond yields have inverted, a classic predictor of recession. This happens when short-term interest rates become higher than long-term rates, signaling a lack of confidence in future economic growth. But what most don't realize is that manipulation of bond markets through Federal Reserve interventions is distorting this signal, making it harder to interpret the true state of the economy. Another critical indicator is credit spreads. The gap between corporate bond yields and government bonds is widening, signaling increasing risk in corporate debt. Investors demand a higher return for lending to corporations when they perceive a greater risk of default. Yet, banks and big institutions are quietly shifting assets off their books, using complex financial instruments to obscure the true extent of their exposure, creating hidden pockets of stress within the financial system. Then, there's real estate liquidity. Commercial real estate sales have dropped sharply, but it's not just about prices. The liquidity crisis, how easily properties can be sold, is drying up, indicating deeper systemic risks. When properties sit on the market for extended periods without attracting buyers, it suggests a lack of confidence in the sector and can trigger a cascade of negative consequences throughout the broader economy. Let's break these down and understand why they matter. First, the yield curve inversion. Historically, when short-term interest rates rise above long-term rates, it signals that investors are worried about the near future. They anticipate slower economic growth or even a contraction, leading them to prefer the safety of long-term bonds. This phenomenon has preceded every major recession in modern U.S. history, making it a closely watched indicator by economists and investors alike. But today, the Federal Reserve's interventions, like quantitative easing and bond purchases, are muddying the waters. These policies, designed to stimulate the economy, can artificially suppress long-term interest rates, making it difficult to discern the true market sentiment. The signal is still there, but it's harder to interpret, requiring a more nuanced understanding of the underlying dynamics. Next, let's consider credit spreads. When the difference between corporate and government bond yields widens, it means investors see more risk in lending to companies. They demand a higher premium to compensate for the increased possibility of default, reflecting concerns about the financial health of corporations and the overall economy. This often happens before economic downturns, as businesses struggle to repay their debts in a weakening economic environment. But banks and big institutions are quietly moving risky assets off their balance sheets, using sophisticated techniques to mask the true extent of their exposure. This can involve securitization, special purpose vehicles, and other complex financial instruments, making the true level of risk harder to spot and potentially amplifying the impact of any future economic shocks. Finally, let's examine commercial real estate. It's not just that prices are falling. Properties are taking much longer to sell. This lack of liquidity is a red flag for deeper problems in the financial system. When investors are unwilling to buy commercial properties, it can trigger a downward spiral, leading to further price declines and potentially destabilizing the entire market. These hidden indicators, when viewed collectively, provide a more comprehensive and timely assessment of the economy's health than traditional lagging indicators alone. Inflation numbers, as reported by governments and official institutions, often don't tell the whole story. There's a growing theory, whispered among economists and financial analysts, that inflation is being actively managed, or even deliberately underreported to serve specific agendas. This raises a critical question. Are we getting the full picture? Let's take a closer look. Show graphs meticulously comparing official CPI inflation figures against the stark reality of real-world prices. Notice the widening gap, particularly in sectors like energy, food, and housing. This divergence is where the suspicion of manipulation begins to take root. The Consumer Price Index, or CPI, a key metric for measuring inflation, often excludes volatile sectors like energy and food under the guise of core inflation. Furthermore, the calculation methods themselves are frequently subject to revisions and adjustments, subtly masking the true extent of inflationary pressure felt by everyday consumers. Fuel for your car, food on your table, the roof over your head, these everyday essentials have been rising at a significantly faster pace than officially reported. This discrepancy directly impacts household budgets, forcing families to make difficult choices and eroding their purchasing power. Central banks, wielding immense power, often use inflation targeting as a political tool. They sometimes resort to printing vast sums of money to prop up financial markets, all while simultaneously insisting that inflation is under control and within acceptable parameters. This creates a confusing and often contradictory narrative. The result of these policies and reporting practices? Official inflation numbers may appear relatively stable and benign on paper, but the real-world costs of goods and services continue their relentless climb, steadily eroding the value of your hard-earned money and diminishing your overall financial well-being. History doesn't repeat exactly, but it often rhymes. Like a familiar melody echoing through time, the economic landscape today shows striking parallels to the lead-up of previous recessions. These aren't mere coincidences. They're patterns, rhythms in the grand symphony of economic cycles. Recognizing these historical echoes is crucial for navigating the complexities of our current financial climate. In 2008, hidden risks in mortgage-backed securities exploded into a global crisis, sending shockwaves through the financial system. The fallout was devastating, with widespread job losses and economic hardship. Today, corporate debt levels are near record highs, and many loans are covenant-light, meaning fewer protections for lenders if companies fail. This creates a precarious situation, as companies may struggle to repay their debts, potentially triggering a cascade of defaults. The 1970s taught us a harsh lesson about how inflation, when combined with stagnant economic growth, a phenomenon known as stagflation, can devastate economies. The oil crisis, coupled with expansionary monetary policy, created a perfect storm of rising prices and economic stagnation. Today, inflation manipulation, through changes in how it's measured, may be setting us up for a similar shock, masking the true extent of rising costs and potentially leading to misguided policy decisions. The Great Depression, a period of unprecedented economic hardship, began with a series of banking failures that were initially hidden or downplayed by optimistic economic reporting. The lack of transparency and regulatory oversight allowed these problems to fester, ultimately leading to a collapse of the financial system. Are today's financial institutions adequately transparent about their risks? Or are we once again sleepwalking towards a potential crisis due to a lack of clear information and accountability? Each of these crises was preceded by warning signs, subtle shifts in the market concerning economic indicators that were either ignored, dismissed, or downplayed by those in positions of power. Today, we see similar patterns emerging: rising debt levels, inflated asset prices, and a growing disconnect between the real economy and the financial markets. Are we destined to repeat the mistakes of the past, or can we learn from history and take proactive steps to mitigate the risks ahead? So what does this mean for you? The hidden economic indicators, inflation manipulation, and echoes of past crises suggest we may be closer to recession than many realize. Stay informed, question official narratives, diversify your financial safety net, Because when the warning signs are hidden in plain sight, it's those paying attention who stand the best chance of weathering the storm. If you found this insightful, hit the like button, subscribe for more deep dives into the economy, and share your thoughts below. What warning signs have you noticed? Let's talk.